Okay, good afternoon.
Good afternoon, sir.
Before we start, somebody should summarize what we have studied till date. 4 classes we have completed, what we have studied. Any volunteer?
So last class we have studied about NPV, IRR and the rate difference and value difference, and we have computed a problem on that. In the Excel we have provided that problem.
Can you tell it in a little bit comprehensive way, elaborate way? From the
Yes, sir. We
beginning,
have
you tell.
started. Yes, sir. So in the last class, we have started capital budgeting. And in that capital budgeting, it's about planning for the. Suppose we are taking it's about capital expenditure, which we are going to make now, but for the future.
True.
And in this we have done 4 methods. First is ARR, that is average rate of return. Next is payback period. Third is in net present value (NPV), and the last one is IRR, internal rate of return.
And profitability index? Profitability index also we have done?
Yes, sir. Yes, sir.
Okay. Okay. Let me summarize. In 4 classes, we have studied. First, we started with the basic format of your financial figures like statement of profit and loss and balance sheet. There, we discussed about different connotation of profits like EBITDA, EBIT, PBT, PAT, return earnings. So many factors are coming from statement of profit and loss. Then we discussed the balance sheet where we have got non-current liabilities and current liabilities, non-current assets and current assets. So current assets and current liabilities, they relate to the day-to-day operation of the business. So that's why that was our focus of discussion in working capital management. Working capital, the term is coming from working means day-to-day, capital means source of fund. So day-to-day, where from you are sourcing the fund, that is the discussion on working capital management. You tell me where we have missed or where I am telling something extra. So next is, after we have discussed about working capital management, somebody of you told that the current ratio is the benchmark, not benchmark exactly, is the most critical ratio to determine the working capital. Then we discussed the individual components, asset side and liability side, and we found out that there is no ideal ratio. You cannot tell that current ratio 2:1 is ideal or 1:1 is ideal. So what we did, we discussed the individual items and found out that current assets, as less as possible, it is good for the management because you are doing everything in cash terms. And liability, if you are able to manage and the suppliers are giving you free interest-free credit, then what's the harm in going for your current higher payables? So after we have discussed this thing, then we understood the importance of going to individual ratio. So we discussed about the ratio of inventory turnover, receivable turnover, then working capital turnover, asset turnover, payable turnover. So all those ratios are indicator that how in what amount of money you are managing the turnover. Okay. Then next what we did, we found out that there are 2 ways of managing working capital. 2 ways we can approach the working capital. One is through balance sheet approach, another through your process approach or turnover approach. So balance sheet approach are all those ratios. Turnover approach, we talked about the cash conversion cycle, which includes 5 components starting from raw material conversion period, work in progress conversion period, then finished goods conversion period, receivable conversion period, and payment deferral period. So all the 4 things you will have to add and PDP you will have to remove to find out the cash conversion cycle. So lesser the cash conversion cycle, better it is. Why? Because more turnover you are managing with less money. So we did numericals on those things, ratios we did, and that cash conversion cycle also numericals we did. Then next we came to the other part of the balance sheet, that is non-current assets and non-current liabilities. So non-current assets, why they are important? Because they are futuristic in nature, they are long-term, they involve more funds, and they are complex, they have alternatives. So more focus is given on your long-term assets. So they are means of producing or generating income. They have primacy over the working capital management. So in this case, we discussed how to compare against the basic investment against the profit. But profit, when we discussed that in profit, what we are doing, revenue minus expense is profit. In expense, you are including depreciation. In the other side, investment is also summation of your depreciation of an asset. So when both sides are same, it is not becoming too comparable. That's why what we did, we removed depreciation from one side to find out cash flow. So cash flow is the basis for deciding the viability of an investment. Okay. So different tools we discussed. One is average rate of return, then your payback period, then these two methods are non-discounted, and your NPV, IRR, and profitability index, those are discounted cash flow techniques. Correct? And if you have got terminal value, what you do whenever you are finding out the viability of a project, what you do, you see the cash inflow, and then what you do, cash inflow you see, cash outflow is available, then terminal value is also discounted, and by discounting you do it, find out the viability. So you have got the accept reject rule for everything. ARR is more than the expectation of the investor. Then what you do, you go ahead with the investment. Payback period, if it is less than the expectation of the investor, then go ahead with the payback period. NPV, if it is positive, then you can think of investing in a project. IRR, if it is more than the expectation of the investor or industry, then you can think of IRR. Profitability index, if it is more than 1, it is acceptable. Okay. So remember, terminal value we have not calculated, but terminal value is also a part which we will discount for 5 years and add up. I have discussed it, but in problem we have not done it. Is it the whole thing we have discussed?
Yes, sir.
Yes,
Okay.
sir.
Okay. Today, let me share a screen. We'll be going to a new area today. So for convenience, I am using the screen which was used in the previous class. It will be easier and quickly we can finish up. Today, we are discussing a different thing. Tell me, this capital budgeting and your working capital management, it has a management perspective or an investor perspective? Anybody?
Management perspective.
It has a management perspective. Reason being, because this is a decision-making process. So you are thinking of making decision for the company and you want to minimize the cost in the company. That's why it has a management perspective. Now, but remember one thing, your study of finance is primarily focused on the investors. Can you tell why? Anybody? It is focused on the investor. What's the reason? The reason is simple, you see.
So they are shareholder of company.
That's fine. But thing is that when you are looking into the management of a company, few individuals are involved. CFO, or the manager, or the you can say directors, and those are knowledgeable people. They understand the subject quite well. But who needs the knowledge? Knowledge about the company, the layman investor wants. So 50% of the US public, they invest in stock market. They don't blindly invest in the company. What they do? They look into the fundamentals, financials, and then only they invest. So their interest also primary. So most of our all over the world, the management education primarily focused on the investor interest. Although we are studying different parts, you see the things that we are studying, capital budgeting and all those other things, those things are management perspective. But why we should understand it again? Because the investor also should know what the management is thinking. Are you getting me? Are you getting me?
Yes,
So
sir.
investors should also know what management is thinking. That's why we are studying all those things. But the whole subject is focused on the investor. So what for investor is interested? What investor wants?
Growth, monetary
Dividends, profit.
Profit.
Profit. So in finance terms, we are telling they want return. Return from their investment. Correct? How the return is coming? If you are talking of a stock, how it is coming? It is coming from
dividend, capital appreciation.
dividend and capital appreciation. So it is coming from dividend. Let me put it like this. It is coming from dividend and then it is coming from capital appreciation. Now you see, dividend is more or less certain, but capital appreciation today, what's the price of the stock? You cannot predict it tomorrow. It will be the same, maybe different, maybe less, but maybe more. So what you will have to do, this capital appreciation, it involves uncertainty. Okay. That means what will happen, you don't know. So you will have to study it. How do you determine the uncertainty involved in capital appreciation? So do you know what's the difference between uncertainty and risk? I have written here, just read. Anything may happen is uncertainty. There is no, you see, gambling. Gambling is based on uncertainty. You go to the your den and there you find that you put some money, you have no certainty that you will get back the money. Who gains at the end? The person who is managing the den gains at the end. Others, they sometimes lose, they sometimes gain, and the game goes on. But what is risk? Risk is measurable. So risk has informed decision, uncertainty is uninformed decision. Are you getting the difference? Uncertainty is chance, uncertainty is unmeasurable, uncertainty is gambling, and uncertainty leads to anything may happen. But risk is measurable, risk is informed decision. But again, you see, in both the cases, there is a possibility, a probability factor is involved. You may get or may not get. Uncertainty has a higher probability of losing, risk has a lower probability of losing. Are you getting the difference?
Yes, sir.
Yes, sir.
Humor.
Sir, can you give an example of risk and uncertainty?
I told you gambling, you are going to a casino, putting some money. Say, what is your name?
So, Aliva.
Aliba, you have gone to a casino, 10,000 rupees you put there. What is the possibility that you will get back the money and come out gainer? Just tell. Probability, odds, you don't know.
No, I
But
don't.
1 is to 100 or something like that. True or not? 100 times you fail, there is a possibility that one time you will gain.
Yes,
And
sir.
you don't know. And you don't know. Suppose I invest in a stock. The stock's name is, suppose, Motherson Sumi. Have you heard about this company's name? This is a company. This company provides auto ancillary products to most of the big players around the world, starting from Mitsubishi, starting from your Hyundai, your Daewoo, your Maruti Suzuki, to everybody, to every company they provide the auto ancillary. So how do Suppose you invest 200. What was its share price? It was 233, I think. At 233, you invested in the stock. Now, what you are thinking? Few factors I am taking into consideration. One is it has a expansion plan. Number is 2 is it will provide equipment. What is that called? Wiring equipments to electric cars. The electric cars will be more prevalent in the coming years. Electric cars. Just I am telling you how you will. So it has big clients. That way also you can tell how much business it has booked for years to come. Okay? Like that, many factors you know about the company. Aliva getting?
Yes, sir.
And looking into all those things, tell me its price will go up or go down.
Yes, sir. By seeing these factors, we can say its price will go up.
Price will go up. So you see with this expansion plan or something like that, its price is 243 today, 10 rupees it has gone up. So you see, with the basis of this information, you are taking a decision.
Yes, sir.
And there is a possibility that you may get return. You may not get return also. But your decision is informed or not?
Yes, sir.
But in gambling, is your decision informed?
No,
Suppose
sir.
in stock market, I am showing an example of uncertainty. There was a company called Alok Industries. Okay. Alok Industries, this company was taken over by Reliance. So investor poured money into this company. They started buying the shares of this company in large numbers. But they didn't take informed decision. So what is the informed decision? Why Reliance took over this company? Is it what Reliance did? Do you know? Reliance was producing this PPE kit and mask through this company. You may say they are doing it for a noble cause, but that is not business. In business, what you will have to see? You will have to see profit. Alok Industries was the biggest exporter of textiles in India. But now you see, what for Reliance took over, how much money they will pump into the company, what is their revival plan. Without knowing anything, people poured money into this company. So finally what happens? Price will not go up. Are you getting me? This is uncertainty. Aliva got it.
Yes, sir. Yes, sir.
Everybody?
Yes, sir.
Yes, sir.
Yes, sir.
Okay. Now you see, for this informed decision, to decide the risk, you are looking into several things. You are looking into solvency, you are looking into management quality, you are looking into liquidity, profitability, future expansion plan, many things you are looking into. Okay. Now, next is, you see, many times people say higher the risk, higher the return. Higher risk leads to higher return. Is it true always?
No, sir. No, sir.
So higher risk. So you see, if you tell higher risk is leading to always leading to higher return, then what is the concept of risk? Risk means you may get or may not get. Are you getting me? But higher risk leading to higher return is not always true. But there is a possibility that you may get. I'm giving an example, you will understand. There is a possibility that you may get higher return from the company. I'm giving you an example. Have you heard about one company called Suzlon? Suzlon is a wind energy company. So in the year 2008, this company was in the forefront. I think its share price was something like 500. Now it is hovering around 10 rupees. Okay. So its management, what is it? Tulsi Tanti is its CMD. around 10 rupees. I don't remember exactly what is the price. So 2,500 rupees, now you see in 10 rupees. So what we can expect? You can expect that this company, which was in the forefront of the wind power business, has got certain amount of possibility that it may go up further. True or not? But what are the factors? One is whether the company has a revival plan. Okay, whether its fund position is going to improve. Okay. Sorry. Okay. So fund position is going to improve. Whether government will auction wind power, primarily this business is dependent on government auctioning. Government will auction wind energy, or they will ask for quotation for wind energy, and these companies, they apply for it. If government is not asking, the government is the sole consumer of power. Are you getting it? So 3-4 factors are there on the basis of which you can say that this company's price may go up. So you see, it is an informed decision, but higher probability of success or lower? It has a lower probability of success. True or not?
Yes.
Because nothing has come out till now. Till now, you don't know anything. But if it happens, management is thinking, but management has not implemented anything. So when it has a lower probability of risk, what does it mean? It means that you have a higher risk. Lower probability of success means you have got a higher risk. True or not?
Yes, sir. Yes, sir.
So higher risk. If all those things become successful, your price may skyrocket to 50 rupees. 5 times it may go up suddenly. So could you get me? How a higher risk can lead to higher return? You have possibilities, but possibilities are rare and far. Then you are taking a risk. You are taking a higher risk with lower probability, and return may be high. But remember, always higher risk doesn't lead to higher return. Higher risk may lead to higher return. Is it clear to you?
Yes, sir.
Now you see, we told that the return of an investment of an equity is divided into 2 parts. One is dividend, another is the capital appreciation of the stock. Now, that capital appreciation of stock or price variation of stock, okay, this price variation of stock, what does it explain? It explains the volatility up and down. Tell me, higher volatility, higher risk or lower risk?
Higher risk.
Higher risk because up down. So companies like Colgate, Palmolive, Nestle, all those companies, you will see your fluctuation will be low. But companies like your Adani Enterprises, fluctuation will be more. So here you have got a higher risk in comparison to your good companies. So good companies are consistent, but their risk is low. So higher volatility means higher risk. How do you determine? Suppose your price data is given. How do you determine the volatility?
Beta.
Beta is fine, but statistically, you tell me which tool will explain the volatility or fluctuation?
Moving average.
Hmm?
Moving average.
Anybody can tell? Which statistical tool explains the variation?
Variance.
So variance or standard deviation? Variance or standard deviation? they explain the variation of the stock. Now you see, suppose we, oh sorry, I missed another one thing. So that is one. Second is, you see, first of all, the measurement of risk can be also through probability factor. You see, I told you, higher probability means your
Risk is less.
risk is less. Lower probability, risk is more. So if you can assign probability to the return, then you can tell, you can estimate it more accurately that what will be the price of the share. Now suppose here I give you one example. Say here my stock price, which company? Let me think of a company whose price is so high. MRF is 68,000 more. Which company has share price at the rate of 40,000? Okay, leave it. I'm giving another company's name. Suppose I'm talking of Reliance Industries. After 2 years, its share price I'm expecting 3,000 rupees. Okay. So reaching 3,000 rupees has a probability of 0.2. 2,000 rupees. Its probability is say 0.2. 2,800. Suppose its probability is 0.6. Can you now estimate what should be the price after 1 year? How do you do it? Probabilistic estimation. 3,000 has a probability of 0.2. 2,000 has a probability of 0. 2,800 has a 0.06. How do you do it? So 3,000 in 0.2, that is 600. 2,000 in 0.2, that is 400. 2,800 into 0.6 is 1480. Correct?
Sir, 1680.
It is 1580.
1680.
1680. So 2680 is a more reliable estimation. True or not?
Yes, sir.
You can also define optimistic, pessimistic, and moderate instead of putting the probability factor. Then you assign the probabilities. How optimistic you are. Then you can find out what is the expected price of the stock. Could you get it? First, how do you determine? Huh? Tell.
Sir, how did you get the 0.20, 0.6?
These are estimations. You will have to estimate what is the probability, what is the possibility that it will go up to this level. So you may ask how you can know it. Simple thing, looking into the future of the company. What Reliance Industries is going to do in future? Is it going to more into retail? Is it going to take over more company? Will it be having some kind of arrangement with Aramco of Saudi Arab? Are you getting it? Will it reduce its liquidity position? So we will have to read from different literatures. The interview of your chairman, okay, interview of the CFO, their management presentation, all those things you'll have to read. Then once you can take a view, yes, possibility is like this. Got it? But again, you see, single-minded, suppose you see no price will go up to 3,000, that doesn't take something good about your estimation. You can have a moderate view also. No, this company will remain as it is. It will keep on focusing in its basic products, and it may not take up in another 2 years. Jio will be at this level only. Reliance Retail will be at this level. Because of certain hassles, it may not take up. So that probability is how much you will have to find out. And another probability is, yes, it is everything is fine. It will go up. What is the probability? Could you get it? So probability will be determined on the basis of how do you see the future of the business. Very good. Higher probability, moderate, lower, like that. Got it?
Yes, sir.
Yes,
Few
sir.
more. Few more.
Yes, sir.
Let me ask to few students. Itisri,
Yes, sir.
is it understandable?
Yes, sir.
Sneha,
Yes, sir.
Shivam, Shivam is absent. Yes.
Yes, sir.
Getting everything? Okay.
Yes, sir.
So one is probabilistic return. That is one way of determining the risk of an investment. Second one is you told that variance and standard deviation. So I think you know how to find it out. So you take it like this. Say here you see we have done this thing in the other class. So we take price of 5 days price. So usually the price levels are always still more, hundreds and not thousands, hundreds and fifties of numbers are taken to find out the volatility. So 5 days price I have taken for Reliance. Then we found out the average. Average is 2482. Then we find out the difference. So difference is like this. So once we have found out the difference, then what we do? We square it up. You know, in standard deviation, we'll have to square it up. After squaring it up, you add it up, then divided by n, that is number 5. Then the figure is 12936. There you find out the root over. So 113.70 is the risk involved with the volatility of the stock price, or which is a risk involved with the stock. That is a parameter, not necessarily.
Sir, what is the unit of this?
Which one? Standard deviation in numbers only.
Okay, sir.
These are rupees. These are rupees. Okay. So you see, what does it mean? It means that from your average, the stock price will, suppose I am giving you two examples you can understand. Say, okay, my average is here. My average is here. Tell me where my which standard deviation will be. I give you two figures, 115, 23. Which standard deviation will be 23? Which one will be 115?
So first one is the 23. The
First
second
one
one.
23.
First 100.
Oh, sorry. 100.
First one is
115.
115. Second one is 23. Are you getting me? So the meaning, how much up and down, that will be defined by this standard deviation. Correct? All are getting it?
Yes. Yes, sir.
Yes, sir.
Yes. So variance is also, alternatively people also use variance, but for variance is more important than you must be knowing. In your statistical courses, you must have studied it. But variance is also used. So variance is, you know, here 12,936, this figure is your variance. Correct? Standard deviation square is variance. Am I correct?
Yes, sir.
Yes, sir.
Okay. Now, till now, could you get it? So we discussed 2-3 things. We discussed risk, return. It constitutes of two things. One is dividend, another is capital appreciation of the stock price. Then we discussed that risk and uncertainty, the difference. Uncertainty means uninformed, gambling, okay, mad decision you can take. Risk means measured decision, it is informed decision, and you have a better probability of return than the uncertainty. Okay. Then we discussed that how do you find out the risk. So first of all, you see, measuring the return is not a big issue. Expected return is another thing I forgot to tell you. Suppose you have got 3 figures. One is expected return, another is present return, another is future return. Among these 3, which one is more important? Are you getting me?
Future return.
What for?
It's a present
Expected,
return.
present, and past. Which return is more important?
The past return.
Why?
Expected.
Because we are taking position in stock by seeing past result.
You see the past, but in which thing you are interested?
Sir, expected.
Future.
Future, that means expected return important. You see, nobody is interested in the past, so you see, you will not go back to the past to get the return from the stock. Only thing you will look to the future to get the return. So that's why expected return is most important in case of your investment. So that's why what we are trying to do. Past, you see, it is the general saying is, does history replicate itself? What is happening in the past, will it be the same in the future? Tell me, yes or no? A company is doing well in the past, will it do in the future same way it will do well in the future?
Sir, it might be.
At some time,
Not sure, sir.
it has
Not sure.
It may or may not, it may or may not. Okay, but there is a higher probability that it will do well in future. A well-managed company will likely to be remain well-managed in future. But yes, what you are telling, there is a possibility industry turmoil or some kind of new product has come, bigger competitors have come. Naturally, the company may be out of the scene. So you know, many Marwadi companies are now out of the scene. They no more are there in the Indian economy. Okay, so what for we are always thinking of this standard deviation, all those things. Why we are discussing? Because these things we believe that history replicates itself. The whatever is happening now to the company may happen in future. With that expectation, we are doing this thing. But remember, these are not useless. Why? To a great extent, this trend and other things, it will be reflected in the future trading. Why? You tell me, who is buying and selling? Who is buying and selling the stocks?
Investor.
Investors. Who are they? Human beings.
Foreign institutes. Foreign institutes.
Whoever they are human beings. Okay. Where from they gather their experience or information? Market only. So their basis of, you see, one buyer, one seller. Buyers expectation is coming from this data only, seller's data expectation is coming from this data only. So you cannot ignore it, because this is the background through which buyer and seller will be buying and selling the shares. Are you getting me? Why your old data and present and past data are important? Because that creates an impression in the mind of the investor where to buy or where to sell. Okay. That impression is crucial for the price movement in the market. So that's why if you know this thing, background information, you can always predict the future better. Could you get me?
Yes.
Yes, sir.
Why? Future can be predicted on the basis of past. Because in the individuals only, their impression is created like that. Okay, so you got it. Expected return is important in comparison to present and past. But past and present data, they provide an indication of what is going to happen in the future. Now, next is, suppose there is some policy declaration by the RBI. The whole market is going up and down. Okay. And Reliance Industries share prices also went up and down. So for 7 days, you took the price, you find out the standard deviation, which is high. Can it indicate anything? Can you tell Reliance share is volatile? Come on.
Yes, sir.
RBI policy guideline has come or is expected to come in future. For this reason, the market is fluctuating. Reliance Industries price also fluctuated along with the market fluctuation. I'm asking you, can you tell the standard deviation of Reliance is high?
No, sir.
In one class, all secured 90 out of 100. Can you tell who is this boy? Can you tell Shivam Prasad, Shivam Parida Pradhan? Shivam Pradhan is the best student. When can you tell? When you compare this 90 and Shivam Pradhan's mark, true or not? Are you getting me?
Yes, sir.
So unless you compare your figures with others, you cannot tell that this person is good or bad. So likewise, when you compare the market fluctuation against compare the stock fluctuation against the market fluctuation, then only you tell something is volatile or not. Are you getting me? So it is a relative risk. Relative risk, how do you define? Relative risk you will define as something which you compare with the broad-based index. What is that one? That is market. You can tell, say, in our case, Nifty, Bank Nifty, those are the indexes. So if you compare against them, then only you will know that there is a higher row. Okay. So you see, this comparison is called beta. Beta is the comparison of your stocks volatility against the market volatility. Okay. Now, so is it found out through covariance? So beta is covariance. Let me write down. So beta is equal to covariance of stock and index divided by variance of the index. Okay, so this is the formula of covariance. So when it is a sample, you take n minus 1. If it is a population, you take n. Correct? Now just see how do you do these things here. So we took the price of HUL price for 5 days. Your friends told these figures to me. 1975, 1987, 2016, 2048, 2078. Okay. Then we are finding out the covariance. So x minus x bar, we will find out what is the formula. X minus x bar into y minus y bar. So x, what is the average? Average is this one, x bar. So it is x minus x bar. You found out 2020.8. 1975 minus 2000.8, that is minus 45.8. Likewise, in the individual ones, 1987, this like that we found out 5 figures. Are you getting me or not?
Yes, sir.
Yes.
Yes, sir.
Likewise, for Nifty, the X bar was 17,435.8. Then I found out 17.222 minus 17,435.8, like that. We found out 1, 2, 3, 4, 5 figures. Then x minus x bar multiplied by y minus y bar. So this 45.8 multiplied by 230.8, 9792.4 is like this. All those figures have come. Okay. Then what you do? Add it up. What is the total? Add it up and divided by n minus 1. So its total is 27,401.80. You add it up. Correct? Then
Yes.
n minus 1, here it is 5. So you divide by 4. It will become C set 50.45. Is it done? Got it or not?
Yes, sir.
Yes, sir.
Then what do we do? So what I told, this is the covariance of stock and index we found out. Then variance of the index. So we have already found out the difference here. You can only square it up. It is squared also. It is squared. No, it is multiplied here. You will have to square it up and add. So this figure, just find out how much is the figure. Tell me individually one figure I am writing.
So for the first one, it will be
45,360.
How much it is?
45,710.
710.44.
Yes, sir. 45,710.
Total.
No, sir.
No,
It
total
is
for
a
the
first
square
one.
of 213.8.
So second one is 121.
45,000.
45,710. 710.
Then this one.
1210 double zero.
And one.
Double zero.
This one.
3868.84.
Another.
795.24.
795.24.
95. Okay. This one.
54849.
5.
5484.6.
Add up.
Sir, 1,12,836.72.
1,10,000.
12,000.
12,000.
836.72. This is as per my calculation.
Okay. Divided by 5. How much it is?
So 22,567.34.
22,567. They have found out that 23,000. Anyway. So your covariance was 6850.45. This one is 22,567 by 57. Divide it. How much is the fraction? 6850 divided by 22,567. How much is the figure?
Sir, 0.303.
0.303.
Okay. So they have found out 0.29. Whatever. Calculation is up to you. Don't bother about the calculation. Now you see 0.303. What does it tell? It tells that if index is varying 1, Hindustan Unilever is varying only 0.3. Volatile or not?
Not volatile.
Less volatile.
Less volatile or less risky. So Hindustan Unilever share you can tell is less risky. Maybe if you are finding out for the Adani Enterprises, it will be higher. Yeah, could you get it? With the concept of beta? Not necessarily same way, the way simpler way we did it is done for the stock market also. There also you see outer layer, somewhere news and other things that is incorporated. But
Sir,
this is
can
the
we
basic.
take-
This is the basic way how you calculate the beta. Tell.
Sir, can we take these values like minus 45? These values means square it up to find the variance.
Which figure?
So
This
the
figure.
minus 40, yes, sir. Minus 45.8.
These figures.
Yes, sir.
But these figures are not important because you see the denominator is variance of the index.
Okay.
Numerator is covariance of stock and index. Are you getting me? The denominator is the variance of the index. So this relates to these figures. Covariance of index, this and this together. This together, this together. Are you getting me?
Yes, sir.
Is it done?
Yes, sir.
Sir,
So-
here, how did you know that one is taken as the index for all the other shares?
Market variation is 1. Suppose I write variance of index and variance of index in the numerator denominator also. Will it not be 1? Because it is a covariance, it is changing. True or not?
Yes, sir.
So market beta is 1. Can you tell a situation where it may be negative? In only one case where you see the financial instruments are opposite in nature. Suppose gold and stock, gold and debt, there it will be negative. Otherwise, it will be lesser than 1 or more than 1. More than 1 means volatile and risky. Lesser than 1 means lesser volatile and lesser risky. And it is also seen in the market. Good companies, their beta usually is low. Good companies means consistent growth. They don't fluctuate much in the market. Why they don't fluctuate? Because people don't want to sell it, because these are good companies. If people are selling and buying, then only price will fluctuate. So good companies, they don't sell consistently due to profit, it keeps on growing. That's why its beta is lower. Could you get it? We discussed 3-4 things: probabilistic return, standard deviation, variation, and beta as the measure of your stock market risk. So you see, these are the factors which will again determine how your return is coming. Let us see how they are determining. You have got a concept called capital asset pricing model. What does it tell? Here your 4 factors are involved. One is expected return, another is market return, another is beta, another is risk-free return. So market return minus risk-free return, that is your risk premium. Okay. So what is the equation? Expected return is risk-free return plus beta into market return minus risk-free return. True or not? Tell me. You just analyze this equation. The return which we are expecting, it will be more than risk-free or less than risk-free?
More than.
It should be more. Why it should be more? Otherwise, you will go for risk-free return. Why you will go for other investment? So it will be more plus. Then again, it is more you have decided. But again, you see, if it is not fluctuating at all, then this figure will come down again. Are you getting? But again, it will be growing lesser, but it will grow. Are you getting me? Suppose this is 0.2. Beta is say 0.3. How much it becomes? Risk premium means market return minus risk free return. So it is
0.06.
0.06. Correct. Now you see another scenario I am telling you. Say beta is 1.2. This is your 0.2. How much it is? 0.24. Correct?
Yes, sir.
Right or wrong? Now do you see here? Both are increasing, but one is increasing at a lower rate, another is increasing at a higher rate. So it will be anyway be higher than risk return. But again, you see, if market return is lesser than risk free return, then your expected return will be lower than risk free return. Could you get the equation?
Sir, what is the market return? Like FD. FD is market return.
What you are telling?
So market, what is the market return, sir? Which one is?
Market return simple. You see, index return is market return. Just I am telling one example. In the year 1985, Nifty was how much? 100. 85 or 95? How much Nifty is now? 17,500, let us put. So how much is the market return? 175 times. Correct? Getting? Now, Again, I am putting it this way. 1900, 1 minute. 1984. Say Infosys was 10 rupees. If you take into consider everything, I don't know how much it will be, but how much it will be? It will be something like how much? 1 lakh, 120, 100. 400, 500 times or still more, 1,000 times. Say, I am not too sure, I am not calculated. So now do you see? 175 times, it is 1,000 times. So if you compare these two, you can always tell how your share is performing. If the return is high, there is a possibility that is there. Not necessarily, again, I am telling you, higher risk, higher return, lower risk, lower return, not like that. Are you getting me?
Sir, what is the significance of that equation?
The seat is visible to you?
Yes.
Yes, sir.
Tell.
Sir, what is the significance of that equation that expected return equals to risk-free?
That's what I'm telling. First of all, we presume that my investment should give more than the risk-free return. So I get a premium on risk-free return. So how much I will get? I should get, first of all, how beta will be determined? To the extent it is beating the market return. Okay. So to that factor I am taking here for my return. Then risk premium, market is giving risk-free return is a debt instrument. This is stock. Okay, Nifty. So this differential within which instrument I am investing, that is also important. That is captured here. Volatility is, as we told, more higher risk is giving to higher return. That is captured here. When both the things are captured on and above the risk-free return, that is my expected return. Got it?
Yes, sir.
Got it or not?
Yes, sir.
Now you tell me, out of these figures, if I give you, say, I give you expected return and I give you risk-free return and market return, you can find out beta.
Yes, sir.
Yes, sir.
This is also another way of finding out beta. So we tell that, you know what is that saying? Dog wages the tail or tail wages the dog. कौन किसको हिला रहा है? पूंछ हिला रहा है कुत्ता को या कुत्ता हिला रहा है पूंछ को? So expected return will be find out from beta or beta will be find out from expected return. Which is easier? Are you getting me? So usually expected return is easier, so you can find out beta out of it. Is it clear to everybody?
Yes, sir.
Yes, sir.
Those are the basics of risk and return.
What is the full form CAPM?
Capital asset pricing model. Let me write down. Capital asset pricing. It is a very famous model. You see in your interview, people will be drop up a hat. People will ask you this question. Do you know what is CAPM? How do you determine risk-free return? You can tell it is the RBI bond rate, or you can tell in US market if it is Fed rate. Market return you can tell. Nifty return we can consider as market return. Okay.
Yes, sir.
You see, because we use the screen of the other class, how quickly finished up. Did you have any difficulty in understanding because it was an old screen?
No, sir.
So in the interim, we'll be getting maximum question from your section only, right?
Yes. I'll give you a framework how to approach the exam. Okay.
Okay, sir. Thank you.
Where from problem will come, where from theory will come. What is my plan? I am telling you, in another one class, I think I have one class in hand. I had four
Yes, sir.
sections. I had four sections with me. One is leverage, capital budgeting, working capital, and risk and return. So I have covered risk and return. I would have covered by the next class, risk and return, working capital, and capital budgeting. This leverage, and in few classes, cost of capital probably was not, sir could not find time to teach. So I will provide you a literature for these two things. You will have to read it. And maybe we'll be having a quiz on this thing. You will read it and I will take a quiz on this thing. A small conceptual quizzes, 5 minutes quiz. Is it fine?
Yes, sir.
Yes, sir.
So that
Yes,
way we
sir.
can cover the course. Otherwise, with all available resources, time, and what we could have done. And mostly whatever I have taught you are simpler things, but you see every day in, day out in your life, people will be asking these questions to you. Risk uncertainty difference, what is CAPM? So which return is important for you? How you can measure risk? Okay, what is cash conversion cycle? What are the major ratios which guide your working capital management? What is NPV? What is IRR? You see, 50% of our questions in NPV will in your finance area will be from these things, whatever I have taught you by this time. Of course, valuation and other things are there, but 50%, that's why I told 50% will be in these areas. So if you understand it properly, nothing like that. And nobody is going to deep into it, complexity. Of course, there are few things I should have discussed, IRR better or NPV better, dual cash flow, multiple IRRs. Those are things you see, maybe because we have a CF2 paper there, we can discuss these things. So CF1, I think this is good enough. Okay, and we could have done a project also on capital budgeting. But with this short time period, it is not possible to do everything. So that's why I focused on giving you the concepts, basic concepts, which you understand conceptually, so that anything you can try. Sneha Singh, are you here?
Yes, sir.
So you don't speak at all? Pratyush? Aditya Agarwal?
Yes, sir.
Are you understanding whatever I am explaining?
Sir, not completely little bit.
But you ask me. If you don't ask me, I will know you are not getting. Sandita?
Yes, sir.
Partly or fully?
Sir, fully.
Fully, good. Gautami?
Yes, sir.
Full?
Yes, sir.
Alok?
Yes, sir.
Okay. So you see, questions will be almost as we have studied, but you will have to apply a little bit your mind. Try it sincerely. I am not giving you on the basis of your answers. The way you have approached the problem, I will give you marks. Your section B will be having 4 questions. You will have to answer 3. Out of these 4 questions, 3 will be problems, 1 will be theory, and your section A will be multiple choice questions. And you have small calculations to do, easy calculations. You can easily do it. Okay. Is it fine? We should close.
Yes, sir.
Avinash Mahapatra, Avinash Patnaik, Aditi,
Present, sir.
Aditya,
Present, sir.
Aishwarya,
Present, sir.
Aliva,
Present, sir.
Alok,
Present, sir.
Aniruddha, Anuradha, Aritra,
Present, sir.
Aritra, sorry, Aritra, difficult name, I can't
sir.
help it. Aritra, Arpan, Arpan Mahanti, Arpan Bahidar, Ashish Paikrai,
Present, sir.
Abhik,
Yes, sir.
Bhaskar, Chandita,
Present, sir.
Chinmay,